Thank you, everybody, for joining us. We are going to continue powering on. We have two fantastic partners to Benzinga coming up next. We have Joseph Cioffi. He is the partner and chair of Davis and Gilbert Law. He is leading a conversation with a man who has been to a lot of Benzinga conferences and done a lot of deals with this space. So, Joseph, please come introduce your next guest and give him a round of applause, please. Welcome him to the stage.
How's everybody doing? We're going to talk about REITs for a little while today. We're going to talk about REITs because I have the man right here from NewLake Capital Partners, Anthony Coniglio, President and Chief Investment Officer of NewLake.
Good morning.
So, Anthony and I have some things in common. We share a few common bonds, but one in particular is that we both have survived, I should say, mortgage lending and securitization over the last, was it over a decade, right?
Yes.
So we've really seen full market cycles. And by seeing all of that, I could say by being involved in something that was from cradle to grave, it is much more fun to be on the front side in an emerging and growing informative market like cannabis. So, I appreciate being here. Excited to continue working with folks in this room. So I guess, the first thing we should do is hear more about Anthony, your background, and NewLake in particular, and then we'll get into more details, Anthony.
Sure. Thank you, Joe, and great to be with everybody today. Thank you for your time. Anthony Coniglio, President and Chief Investment Officer at NewLake Capital Partners. Quickly, my background is over 30 years in financial services and real estate, having led a number of businesses at JP Morgan before starting up a residential mortgage business. And you're right, residential mortgage business has booms and bust cycles, and it really prepared us, I think, well for a world inside cannabis with all the volatility that exists in this industry. What's NewLake Capital Partners? We're a publicly traded net lease REIT. We went public last year. We were founded over 3 years ago. We're the second largest owner of cannabis real estate in the country. We have 28 properties across 11 states with 11 tenants. Our tenants are some of the largest and most well-known cannabis companies in the world. Names like Cresco, Columbia Care, Curaleaf, Trulieve. But we also have small single-state operators or small multi-state operators that we think are those diamonds in the rough, great companies that maybe are less well-known, companies such as an Organic Remedies or a Revolutionary Clinics, or even our newest tenant that we announced last week, C3 Industries. We've been in business for over 3 years. Since inception, we have had no defaults, no deferrals in our portfolio. Knock wood. I think our team's done a great job in portfolio selection. Ticker symbol is NLCP. Okay,
that's very helpful. So, we've heard a lot about over the last couple of days, the rise of debt financing. And, there's several alternatives for operators in the space. There's traditional debt financing, which, as they is on the rise and more. But also in terms of REITs, there's mortgage REITs, there's equity REITs. What are the advantages, particularly of an equity REIT?
Yeah, and so I would answer that in two ways. I think, from an investor perspective and from an operator perspective, since we have a lot of investors here. I think from an investor perspective, what an equity REIT offers is more around duration, around a portfolio. Right now, we have a weighted average remaining lease term of almost 15 years. Our weighted average yield on our portfolio is 12.6%. I think when you contrast that to a mortgage strategy, it's a different approach. Term duration has a little bit of a different risk profile. And our team has been at it. We have a terrific team, both on the board and the management team, that's been at it in cannabis, in real estate, and in financial services. From the operator side, it's really a different answer. We get this question all the time when we're talking to tenants and potential tenants that are looking at debt versus a sale-leaseback transaction. Sale-leaseback, for those that don't know, is where we acquire a property from the tenant, from the operator, no disruption to their operations, and we enter into a long-term lease with them, typically 15 to 20 years. And in that instance, the operator's looking at debt versus sale-leaseback and saying, do I want to have one risk profile versus the other, is the way I dimension it. And that risk profile is, with debt, you have typically floating rate debt. And in a world right now where rates are going up, do I want to have the volatility in my P&L from having a large amount of floating rate debt on my balance sheet? Number two, do I want to have to worry about the rates when I refinance 2, 3, 4 years from now? Particularly when you look at where many of the economists expect rates to go over the next 2 to 3 years. Then there's a matter of covenants. Some people want to operate their business under a regime of covenants, and others are of the mindset with a very with the absence of covenants really in our transaction, to be able to manage their business and know that there's volatility in the business and that they don't have to worry about a tight covenant set. And then there's just the time to go out and refinance. These transactions, as most people in this industry know, takes a lot of time to execute, particularly on the debt side. And so you want to take that management time to have to refinance risk, to refinance that debt. And then ultimately what we talk with folks, I've yet to see somebody who says strategically long-term, I want to own my property. Right? It's not a good use of your equity capital to actually own real estate. It's a hard asset that has limited upside. Rather, I think investors are providing capital to the cannabis operators because they want them to generate EBITDA and they want them to generate growth in their core business, what they're good at, which is either growing or dispensing and selling cannabis and creating brands. And so ultimately we think even if somebody is choosing a debt transaction today, that's a sale leaseback transaction in the future, because similar to what we see in other industries such as a Walgreens or Starbucks or a Home Depot, they all net lease their real estate because it's not a good use of their capital long term to invest in real estate.
No, that's great. So for investors, there may be a little tension there between what's good for operators and what's good for investors, or I should say maybe just a tight line or tight rope that you follow. So for the investors, one of the benefits is that it's a long-term relationship, right? And for the operators, lower costs. They're locked in longer, but I'm sure there is flexibility in working with them.
Sure, that's exactly right. And I think when you look at take it from both sides, from the investor perspective, we have a tenant relationship, and most of our tenant relationships are built around growth. And so we have many properties on the cultivation side where the property itself has room for expansion. And those tenants want to know that they have a partner that has the ability to be there for their expansion 12 months, 24 months, 36 months from now, as the markets they're in grow and mature and they want to expand on that property and gain access to additional capital for build out. So that benefits our investors because we have, I'll call it that built-in growth, in addition to the 2.5% escalators that are built into our contract. So our revenue is growing 2.5% every year. Yet you mentioned on the operator side that maybe there's tension. We don't think of it as tension. In fact, when we talk to our operators, what we tend to find is they like to know that a significant amount of the capital need they have for their business is put away. It's done. And it's typically cheaper. You're correct. It's typically cheaper than what they would be able to get in the unsecured debt market. For the larger MSOs, maybe that's not the case. It's an alternative source. But for many of the mid-sized MSOs, mid-sized players and the smaller state players, it's absolutely cheaper on a near-term basis versus taking on what is mid to high teens cost of debt.
So you mentioned cultivation. Can you talk a little about the different structures you might have for different types of deals that you do? You're in all different types of property, not just cultivation, I believe, right? And dispensaries and.
Yes, that's right. We have 28 properties today across 11 states. We have 17 dispensaries, and the balance are our cultivation facilities. By capital, it's over 90% of our capital is invested in cultivation. As you could imagine, right, these cultivation facilities, some of these deals are 30, 40, $50 million, where in a dispensary, it'll be anywhere from 700,000 to 5 million. And so from a number of properties, we have a lot of dispensaries, but from a capital, it's really over 90% is in cultivation. And so when we think about the deal structures, we tend to get longer duration on 15 to 20 years on the cultivation. The dispensaries tend to be in the 12 to 15 year range. And given dispensaries are typically in more well-trafficked areas and have a better alternative use, that pricing tends to be, call it about 100 to 150 basis points cheaper.
So is there a preference right now? Your recent transactions, is that a trend?
We don't have a preference. We like both. We love the diversification that we get in our business by having dispensaries and cultivation facilities. I'll tell you that the operators and the tenants in our portfolio and the ones that we speak to like that we can serve all of their real estate needs across cultivation and dispensaries and processing. We're not just a cultivation only or a retail only shop. So we like the diversification it gets. They like the fact that we can serve all their needs. There is no preference right now. What we look for consistently is good quality operators with good balance sheets, line of sight to good, strong cash flow, in markets that are typically limited license, because we think in those markets where the license and the property are typically connected, that it creates better value for our shareholders, better value for the properties we own, and better durability for the cash flows under our leases.
So I was going to ask you about this, about managing risk, based on location, type of property, but I think you just hit on something, which is quality of the team, right? And quality of management. I'm assuming that's one aspect that you're looking at. What do you go through when you're thinking about how do I manage my risk when I'm doing my diligence on an operator?
For sure. Yeah. For this is where we spend most of the time in the company. Well, we focus, Joe, we really focus on 4 items when we're looking at underwriting. Number one is diversification. We'd like to look at opportunities to diversify our portfolio. And if you looked at the last 5 transactions that we've closed over the last year, all of those have been with new tenants, and many times in 2 of them in a new state for us. And so looking to build upon the diversification. 2 is we look at the company, right? Just the way you would in any sort of either lending or real estate transaction, long-term relationship. You're going to look at the quality of the company, the balance sheet, the P&L. Of course, we all look at that. But there are 2 elements within that we emphasize. Number one is that management team's ability to operate a high-growth business in a highly regulated industry. It's one thing to be successful. A lot of people, a lot of entrepreneurs come into this industry from other industries, the way we have. And that's great. But it's really different running a high growth business in a highly regulated industry. And so understanding their ability to do that is very important. And then the other element is their ability to raise capital. One thing I can tell you that we've learned over the last couple of years, in 3 years and being in this business, is these businesses have voracious appetites for capital. And it's one thing for a company to be able to raise that seed round or that friends and family round, but it's another thing to be able to raise that institutional round of capital that's needed to fulfill their business goals and objectives, or needed to refinance debt that may be on the balance sheet or to recap the balance sheet. And when you look at most of the issues in the industry, it's been because management teams weren't able to refinance debt or weren't able to raise capital to continue their trajectory. So that's 2. Number 3 is obviously the real estate. And we do everything you would expect, but we've also developed a number of proprietary metrics that we look at. And we've looked at over $4 billion of transactions. And as I said, we have 28 properties across 11 states. So we have a lot of experience. In addition to experience on our team, one of our directors was the former CEO of GTI, Pete Cadence. And Pete's been on our board from the very first day when we started the company in early 2019. We've institutionalized that knowledge and built upon it as we've looked at the $4 billion of transactions. And we see a lot of consistency from deal to deal in terms of some of the metrics. We look at the yield coming out of the cultivation facility. We look at the foot traffic into the retail location. We really try to understand that property's value in the cannabis ecosystem, not just the property's value in in an alternative use market. And then the 4th element of underwriting, I'm going on because this is where we spend most of our time. The 4th element is we do look at the jurisdiction. As most probably know in the audience, this business isn't just it is a national business, but understanding it isn't just a national perspective. It's a state perspective, it's a county, and usually it's a city perspective. And so in our portfolio, our transactions are squarely in limited license jurisdictions where we think we have additional value. And so we look a lot at the jurisdiction the property is located in, not just what the licensing construct is today, but what do we think that construct will be 2, 3, 5 years from now? And how will it evolve? Yeah,
it's all important. I really appreciate this because you obviously know the benefit of very strong underwriting.
It's the core of what we do. We have 15 to 20-year relationships. And in order to deliver the growing dividend that we've been delivering for our investors, and we've raised our dividend 4 times over the last 4 quarters. In order to do that, we need tenants to pay rent. And so underwriting is the centerpiece of what we do.
I think it's a great assurance for investors to know that it's really strong, credible underwriting.
For sure.
So let's talk a little about regulations. I know over the last couple of days, there's been a lot of talk about regulations and the Safe Banking Act. And, I guess just to tailor it to NewLake and to an equity REIT, like what do you think the effect would be if it ever were to pass?
If it ever were to pass. We're decidedly in favor of safe banking. We think it's an unmitigated positive for the industry. We think it's positive for us and our portfolio and our investors, and here's why. Number one, it simplifies the business for our operators. It allows them to accept credit cards, and we expect our tenants to see increased revenue and increased cash flow as a result of facilitating the issues that may be confronting them in their banking activities. And so it's a net credit positive for our portfolio. Number 2, increases our access to capital, and our cost of capital will go down. When you think about banking, I know a lot of people think that the banks will rush into this industry and start lending to the operators. I'm more negative on that. Folks that have talked to me in the past know I think the industry overestimates, having been in banking for a large part of my career, I think the industry overestimates how much the large money center banks will actually bank individual companies. Rather, we think that a diversified portfolio of professionally managed commercial real estate is more likely to garner significant levels of capital from banks. And if the dialogues we're having with various banks over the last 3 to 6 months are an indication, I think they're more apt to provide capital to us rather directly to cannabis operators.
That's really interesting because some folks would think that it's really a negative for the REITs if there's more traditional banking coming in, but no, because there's just a greater flow of funds coming to the market and driving cost of capital down, as you said.
Yes, and I think a lot of people, for those that haven't read it, I'd say read it, because there is a provision in there that allows federal regulators 6 months to write the rules. And anybody that pays attention to banking, it'll take 6 months for the Fed, the OCC, and the FDIC to schedule the meeting. And in fact, just look at hemp legalization. Right. Hemp was legalized in 2018, and last year we were still getting rules for hemp. Yeah. And hemp is legal across the country, whereas these federal regulators have to write rules for thousands of banks that operate in some states where it's legal and some states where it's not. So it's extremely complicated, and I'll take the over on the 6 months. I think it'll take them probably 18 to 24 months to get the rules written, and my experience tells me banks don't move until the rules are written. Why would you take compliance risk during a rulemaking period only to find that you did it wrong and you're subject to fines and discipline from federal regulators?
Yeah. So there's just been a lot of speculation about when Safe Bank.
When do you think it's going to happen?
I'm going to speculate too. I'm just going to basically say that, what I like to say is that satisfaction is a function of expectation, and nobody should expect anything anytime soon, and we'll all be satisfied. I think it's going to be over a year. When you look at what's going on in Congress, I think we've got, and I won't blame either side. It's just on the Democratic side, there's a little torn between, do we want stepping stone approach or do we want broad sweeping reform? And on the Republican side, they're more about the State Reform Act and giving more authority to the states. So what could possibly happen when you have actually 3 views, not 2, but you have 3 really strong views in Congress? So it looks like it's going to take a while. And I think no one should expect any real activity until after the midterm elections. That probably just makes the most practical sense at this point. Right?
Yeah,
what do you think?
Yeah, no, I agree. I do think this industry tends to be overly optimistic around a lot of things, and in particular legislation. And I think this industry tends to believe that this topic as a voting matter is more important than it really is. I think that while there are legislators that are serious about cannabis reform, I think as an issue in the landscape of all the political issues out there, I think this is very, very low on the list. And I don't think many legislators and many politicians think that getting on one side or the other of cannabis reform is going to win them a meaningful amount of votes that allow them to swing an election. Yeah. And really, ultimately, I think that's going to drive the fact that this isn't just going to get done this year.
It's funny. I just feel like everyone adjusts, right? I mean, everyone's expecting something to happen, but if it doesn't, we all move on, right?
Right.
To me, it's just like what happened with remote and working from home. We all just adjusted. Everything's fine. So,
yes. Well, we hope it does pass, and we're actually huge advocates of it. I hope I'm wrong, and it happens sooner rather than later, because it's really important to the industry.
Yeah. So it'll be good when it happens. So speaking of regulatory issues, just turning to ESG, environmental, social, and governance issues, Anthony, just social equity licenses. There have been several missteps, it seems, by the states in these programs. So I'd like to get your point of view on them and how maybe you've worked with them or your considerations in social equity when you do your deals.
Yeah, it's hugely important. It's hugely important for our company. It's very important, as we all know, for the industry. I applaud the efforts that the industry has made to make this a real issue and a centerpiece of legalization. I applaud what the state legislatures have done in trying to advance it. But where I think they've failed the industry and failed the social equity licensees is not recognizing the amount of capital. I'll go back to what I said before, voracious appetite for capital, and not recognizing how much capital is necessary for a company to truly have long-term success in this industry. And when you look at Illinois and you look at the craft grow licenses that they've awarded, it's limited canopy. How hard is that when you're a subscale player in a world where we know prices are coming down and the cost per pound is coming down? how do you, when you're subscale, get your cost of production down to a point where you can truly be profitable for the long term? It's enormously difficult, number one. And then number two, it takes a lot of capital to be able to invest. And so states like Illinois and New York are creating loan programs, but they tend to distribute, they tend to want to help everybody. And I think that's laudable, right? Yeah, we should be trying to help as many people as possible, but as a result, you end up giving not enough capital to any one operator, which means they're fighting with one arm tied behind their back. And so as an industry, in partnership with the states, we have to figure out a way to be able to provide more capital, not just training, there's a lot of training, but it's training, but really provide more capital to those social equity licensees so they have the runway to get to success.
Yeah, and you say it too, that education is important too. Right? Hugely
important. I know a lot of the MSOs out there are part of education programs. We all need to do more of that.
Okay. Well, we're winding down here, so I do want to ask you though, Anthony, you've been so successful, such a great track record. Now, so how do you keep it going? I mean, like times are changing a little bit in the economy, inflation, rising interest rates, a little uncertainty, the evolving structure and the regulatory schemes. How do you make sure it's successful going forward? What do you do? Advice.
It's very very kind. I think first, it's about the team, right? We have a great team. Our board is phenomenal. Our team is phenomenal. And it really starts and ends there. And so once you have a great team, you can accomplish great things. Without a great team, you can't do that. Yeah. And so we spend a lot of time focusing on the people we bring on, the people we partner with. And that's just about being grateful. I don't want to get too hokey, but all of us in this room, we're just really grateful to be in on this industry, to have the opportunities that we've had.
Yeah, it's important. I mean, I just think you're doing the right things, and we know from the past that things sometimes can go unexpected and unintended consequences. So it's really important for everyone while times are good, just make sure all the documents are shored up and very protective, and knowing good times can change sometimes in the economy, but let's keep it going. And you've done so well. Wish you continued success. Thanks a lot. Thanks for being here.
Thanks, everybody. Thank you.